The simple idea of the chain is that I wanted to pick the brains of one of my investment heroes. I chose my good friend Kyle Bass, and in turn I wanted Kyle to pick the brains of his investment hero. The idea in the end is to create a chain of peer-to-peer interviews spanning the globe. Hopefully it should unveil some of the great minds in finance, and hopefully we can all learn something along the way. Kyle, good to see you.
Good to see you too,
Thanks
Raoul.
for hosting me here at this most unbelievable place. I've been here a few times already and it's just spectacular.
Thank you. It's our Walden.
Yeah, and what's also great is we're here for the Barefoot Economics Summit, which is, I think, and I go to a few of these things, the best in the world, because it's a private group and it's small and it's good thinkers, and you don't get that often, so
Yeah.
it's cool.
It's always my favorite time of the year.
Yeah. So kicking off, I think the best thing is to understand, just for people to understand where you came from, where, you know, how you got into the business, how it happened.
Yeah, it was just more of a fluke, but I don't know if you even know the answer to that. But yeah, so I grew up in kind of a lower middle class family, and my dad was the manager of a hotel in Miami, and it sold from private to public hands back in 1980, and we moved to Dallas based upon his job relocation, and I went into came out of high school with a sincere interest in kind of both math and science. That's where I excelled and did the best in my studies. And I went to college with the expectations of wanting to be a doctor. My mom was kind of a hypochondriac and was a self-diagnosing champion, and got me as a child to start thinking about, you know, dosings of medication and which medications were good for which ailments, and now which I'm completely medication free because of it. But in my junior year in school, I was to take I was a chemistry major on the pre-med track, and I took a non-major elective. I'd always been fascinated by the financial markets. Neither one of my parents ever saved any of their money. They always were paycheck to paycheck. So I had no formal training whatsoever in investing, but it always fascinated me. So I took a class entitled Options and Futures, and I read the entire book in a week. I took all the practice quizzes and had the highest grade in the class and changed my major. So amazing. It was that moment, that kind of that epiphany that I had, was just taking something that I happened to be interested in, and I got to bring in kind of applied thought with the mathematical background.
So you didn't study economics at all?
No.
I think that's probably a plus point.
I've become a student of economics.
Yeah.
But
exactly.
you know, through baptism by fire.
Yeah. So after that, so you graduated and then?
Yeah. So I'm in undergrad. I graduated with a major in finance, in real estate finance, and I immediately had the bug, and I wanted to be on Wall Street. And again, no formal training, no one really guiding me whatsoever. It was just kind of reading as many Norman Vincent Peale and Tony Robbins books as I could read as a youngster, and just decided that I was going to go interview with every single Wall Street firm until one of them hired me. And I interviewed primarily, given that background, I interviewed primarily at retail brokerage shops. And Prudential Securities happened to be the one that gave me even a third interview. And the guy said, you know, look, we normally hire people that are moving into their second career. We've never hired anyone directly out of undergrad. Why should I hire you? And I said, because if you don't, you'll be sorry. And he hired me. So, you know, I spent about a year and a half there, and realized that I went through the global training program. And as soon as I realized where the different hierarchies of thought were, I ended up figuring that Bear Stearns was a much more entrepreneurial place for me to work. So I was top of my class at Prudential nationwide and decided to move on to Bear Stearns.
And what were you doing at Bear?
1995, I started working with event-driven hedge funds on investment strategy. So I took the $2,500 that I had earned, bought a plane ticket to Geneva, and went to the first MAR hedge fund conference that there was.
Wow.
And met a bunch of people.
I think I started exactly the same time.
95.
Dealing with hedge funds.
Yeah?
In about 95, yeah.
Yeah.
Because it was just the start of the industry. It kind of really
no one even
blew
knew what
from
it
there.
was back then. Bear was a really entrepreneurial place. If no one was covering them, the world was your oyster. It wasn't like Goldman or some of the other firms had geographic specificity in their coverage universe.
Yeah.
The world was wide open for Bear, so it was exciting.
And then you eventually moved on into money management. How did that?
Yeah, so my goal all along was to run my own fund, and I told the people. So at Bear, I was there 6.5 years, and when I left Bear, I was the biggest business unit at Bear outside of New York, and business unit in coverage. And I met the people that ran Legg Mason, and they wanted me to start their Texas operation, and they said that we want to give you a contractual term, and they gave me a 5-year contract. And I told the guys that ran it, I said, in 5 years and 1 day, my firm will be open, but your firm will be running very well. And I was able to leave about 6 months early because if you remember, that Legg and Citi did a fateful asset swap in December of 2005 that affected a change of control provision. So I launched my firm in February of 2006.
So that was Hayman?
That was Hayman.
So when you started Hayman, what was it? Because it morphed a little bit over time because of what happened in markets. But when you started it, what kind of strategy were you trying to run?
It actually hasn't morphed.
It hasn't.
I think that's your view, is that it's morphed.
Yeah, maybe.
Interestingly enough, when I launched, people were telling me that, and friends were telling me that the docs needed to be specific about the asset class and the manner in which you were going to invest. And I didn't want to back myself in any corner. So I had the intention on day one to be global event driven. And what that means is any asset class anywhere in the world, it's how you define the event. And it's what we do. And the reason I think people view us as more global macro today is the events have become the macro when the bad assets went from private balance sheets to public balance sheets. The public balance sheets began the event. So we've just followed the global events. Although, now we still do micro.
Yeah, that's what I was about to say.
We always
you still do a lot of event-driven micro stuff.
When we launched, we were 60% net long equities and massively short mortgages, and we were long equities all over the world, all event-driven equities. So some of our best years of performance, about half the performance came from equities, believe it or not.
But that's a rare skill set. I mean, you just take it kind of blasé.
It was just luck.
No, but come on. You'll take it as if it's a bit blasé. But to do event-driven stuff and macro, very few people can do that.
Yeah.
And you saw event-driven as part of the macro universe, essentially.
That's right.
So talk us.
I still do.
Yeah, I think that's smart because it's different. Because I think event-driven guys get into trouble when the macro changes and they don't realise it.
Yeah, I agree.
So talk us a bit about the event-driven. What kind of things do you look at? What kind of trades? And how do you find those trades?
Yeah, it would be like me asking you how you found your best friends in life, right? In my opinion, there's no true science to it. It's an art, right? You can say that you screen 10,000 companies from the bottom up, and I wish I could give you this real analytical BS answer, and that's just not the case. And so, we're involved deeply in Japan. How did I get involved in Japan? When the bad assets were moving from private balance sheets to public balance sheets, I decided to look around the world to try to understand what the public balance sheets look like. This is in late 2007, late 2008, Q3 of 2008. And there were no great studies of public balance sheets in 2008. Nobody had on-balance sheet debt to GDP in addition to the size of host countries' banking systems. Not one sell-side firm had it. So we decided to get our arms around the world in a very simple way. It wasn't rocket science, but no one had done it. And then we got into, every report I read said Asia X Japan, X Japan, X Japan. Why are we Xing Japan out of all of our studies? I want to understand it. And I happened to have kind of stumbled on Japan when I was doing a global sovereign analysis, and it happened to be right at what I think is an inflection point or bifurcation point when their population was beginning to decline.
Yeah.
So it was a little bit of luck. But as you get into event-driven scenarios, you find some through traditional channels.
Yeah.
You understand negative convexity really well, I think, once you understand how the tails work. And you understand how to stay away from negative convexity, which is really key in the event-driven universe.
Yeah, I was about to say that, because event-driven is all about the probabilistic risk, the downside versus, particularly in merger arb and stuff like that.
Yeah, we don't do a lot of merger arb.
No.
And, a perfect example is, I don't know if you would consider Argentina event-driven. I do. Right? There's an event.
Yeah, I do.
Rufo expires in December. The politics and the game theory of the politics play. The various personalities of the players are very important to understand. And the event's all going to happen in the next 12 months.
Yeah.
And it is a tremendous opportunity.
So here's a question then, because something like that is somewhat relatively easy to understand, very difficult to structure. How do you do the trades? Because that's one thing you're king of. You've been you were right at the advanced forefront of understanding trade structuring when it comes to risk reward. People didn't look at things in the same way before you and Mark and a few others, John Paulson, managed to look at the way of understanding tail risk and put it into your favor in an event-driven situation.
Mm-hmm. In Argentina, there's no great way to hedge.
Right.
So you can look. Here's a kind of a real rudimentary answer to your question. If you look at the curve in Argentina and you think that they're going to end up settling with the holdouts and reaccessing the capital markets, what's likely to happen is their curve's going to do great. Right now, the curve's inverted, as you can imagine, because they're in a technical default. However, what you see is the bonds that are due in the immediate term, meaning the ones that are due in a year, trade on 17% yields, 18% yields. However, what does that mean? They're trading at 89 because they're due in less than a year. And the bonds due in 33 might be trading in the 50s, but they might only be trading on a 12. So an event-driven guy, a young guy, by the way, someone you know in my firm, will come in and say, we need the 17% yield. They're going to be able to pay off that bond in April of next year. And I said, wait a minute. Why are you going to pay 90 for something that could actually really default and then you get 50? Right? You lose 40 there, the upside downside there, because you're after a few extra points of IRR. I'd rather own the 12% bond that's going to sit at 53, even if they restructure. So I think it takes kind of an older hand to understand the risk reward in a curve.
Yeah.
And so from our perspective, you want the longest duration, cheapest as a percentage of par, because if things do go wrong, which Argentina's proven to be able to do some things that are pretty wrong over the years, then you're actually protected. So that's kind of an easy answer to your question.
Yeah, and do you look at currency as well and equity plays around it, or do you just build a core position in a particular asset?
Yeah, so I think I look at the ups and downs, the various probabilities of success in all the different asset classes, and then we make our investment. For instance, in Japan, almost the entirety of our investments in the currency. I don't know which way their equities are going to go. There's this common Pavlovian belief that as soon as the yen weakens, equities go higher. That relationship could break down, especially if the yen moves higher too quickly. So I think the upside downside in the equities is very different than that in the currency. And so we are much more focused on currency in Japan than we are in the equities market. In Argentina, we have a little bit of both, because again, I think the equity upside is still 3-1, but I think there's much higher vol. I think the bond upside is 1-5 or 5-1. I'd rather be in the bonds.
Yeah.
Right. And so we have a hybrid there. In Japan, we're almost all currency, and we look at every instrument that there is.
And if you think about constructing portfolios, how do you look at that? Because everyone comes at it in a different way. So, Stan Druckenmiller, I think, can kind of manage 250 different positions in his head. Other people are down to 3 positions only.
Yeah, I can't manage 250. I think
how do you do it, and how do you look at it?
I would say where I have complete focus and 100% of the knowledge that we can have as a firm, I can have that in 10 positions. Outside of that, I need to really rely on the rest of my team to cover the balance of those positions. Our key positions, I'm 100% involved with.
And do you look at the correlation between those positions, or you look at each in their own right? I mean, how do you look at this?
Well, we look at historical correlation, but we also determine as to whether or not that correlation is going to change.
Yeah.
For instance, the most recent move in the yen, the correlation between yen and equities changed. More importantly, the correlation between U.S. 2-year rates and yen changed. Right? When you think about macro and currencies are multivariable equations, and the past doesn't necessarily tell you how the future is going to play out. And when you think about the various contributors to the movements in these asset classes, I assign probabilistic weightings to each variable, and we determine which variable means more. And we're coming to an inflection point, we believe, in Japan, where the historical relationship between U.S. 2-year and Japanese 2-year rates, which has historically been very highly correlated to yen, is about to break down, in our opinion, because of the extreme policy divergence that we're about to see.
And I think that's one of the key things for me in global macro, as we were talking before we started the interview, about global macro is all about trying to look at all of the different paths, assigning some sort of probability to them, and reassessing those as you go along.
That's right.
And particularly with stuff like currencies, as you say, because currencies are simple to understand, very difficult to understand what drives them.
That's right.
Because it changes.
And you bring the politics in. Look, the politics of each of these situations is so fascinating. I'm not a political person per se, but it's really game theory and behavioral, right? It's behavioral economics almost, where what's in it for the players and what their motivations are and who the key players are. And I think that factors so much into the way that we think about these different situations.
So going back a bit to the portfolio construction, so you've got the 10 ideas. How do you size them? Or is it just kind of happens when you're focusing, it naturally becomes the larger position because most of your energy is involved in that trade and therefore it's happening now? Because it's something everyone struggles with.
Yeah, I think even the best in the world struggle with sizing. And I wouldn't put myself in the best in the world category, largely due to our most recent results. I constantly feel inadequate, which maybe is what drives me. And I think from my perspective, we currently carry some of the biggest positions we've ever had as a percentage of AUM because our conviction level, my positioning is very correlated to conviction level. So interestingly enough, it was a conversation with you. The biggest currency position we've ever carried as a firm was about 35%. And we sat at my house a few months ago. And I walked you through my thesis. And I said, Raul, what is a real position with this thesis? And you said, it's 150 to 200% of AUM in a currency, in a G7 currency.
Yeah.
And my team and I had determined that the team was comfortable with 30%. So there's this gap between a high conviction position and a low conviction, and a very low tolerance for risk management position. And I moved it closer to your target, and it paid off very well a couple of months later.
I mean, that's the problem is risk management. Because suddenly, when you're used to having a low volatility fund, and when you've got big positions, you can't avoid having high volatility unless you happen to be the world's best short-term trader in huge size, which is not a skill set most people have.
No.
So how do you look at risk management? I presume you don't look at VAR, or you...
We don't look at VAR. No. We look at risk management in its totality. We have a few ways of looking at it. Position level risk management, portfolio level risk management. I look at it in 2 ways.
Yeah.
We set position level stops and target levels in which we will either peel back or add or come out. Portfolio wide, we have risk levels of down 2, down 5, down 10 portfolio. Various things happen. Down 10 is almost mandatory risk reduction across the board to live again another day.
Yeah.
Down 2, realistically, we meet as a team all the time. We have we have an investment committee of 4, and then we have an investment team. The IC interacts all day, every day, but we have formal meetings when things are going poorly.
And when you're setting those position limits and the risk limits, do you look at it in terms of how much percentage of NAV you can lose if it goes wrong, if it hits your stop level?
Yes.
And then you kind of add all those together, and you don't even assume correlation most of the time. Cause
we don't.
No.
However, when the positions get large, for instance, again, I keep using current positioning because it's topical and it's something that's on my mind 24 hours a day.
Yeah.
If we're carrying a yen position that's say 100% of NAV, and we're also net long equities, those, let's say even US equities, those two have been pretty highly correlated. Weaker yen equals higher equities in both Japan and the US.
Yeah.
So kind of risk on has meant correlation together, risk off has meant correlation together. So we think about the enormity of that correlation when the positions are very large.
Yeah. But as you say, there's the opportunity, I think, is going to be the fact that some of those are going to decouple.
Yes.
And that's, I guess, our job is to all look at that and understand when is it going to decouple and what the opportunity is, because then there's some great opportunities.
That's right. And that's really talking with the sell side and various other players. I can gather a consensus in 10 phone calls.
Yeah.
And then I can decide either what they're missing or what they have right.
Yeah.
Because we've been known as being contrarian, but we've been generally with the pack the last couple of years.
Yeah.
Because we agree with them.
Yeah, and that's interesting about you is people get snapshots of you. So they only hear one thing, which is Japan, which is a separate fund partly as well.
Right.
Okay, it also appears in your main portfolio, but it's a separate fund. So people think, well, that's his whole thing. Well, it's not, because whenever I talk to you, it's always like you've come up with another new idea that I've not looked at in something wildly different. And
that'll be for next year.
Yeah.
We should talk next year.
Exactly.
You'll like that one.
Yeah, I'm looking forward to that.
Yeah.
You've hinted that there's something interesting going on.
Yeah.
So
one of the most exciting, when you get really deeply involved in something where you know that you can affect change and you can really do well for your investors. It's a really exciting
Did you get that feeling in 2006 when you and Mark got together and started looking properly at the situation in subprime?
Without a doubt. However, since it had never happened before, and since securitization had never broken down before, and all of the market professionals that we met with, the various synthetic CDO managers, the street, were all saying, I mean, come on, these loans have 20% of equity, right? They're 80% LTV loans. You have to lose 20 points before these securitizations get hit at all. And you had enough people telling you that you were just crazy that you believed it to a certain extent. Meaning that we only believed that it could truly happen once it started happening. Then I'll never forget, there was one day where the entire complex, sold off 4 or 5 points, and we made hundreds of millions of dollars in a day. And I sat down with my team and I said, this is it. It's happening. It's going to happen. Everything that we had prepared for so long and put all the blood, sweat, and tears into was proven. That day of vindication was one of the greatest days of all time. Unfortunately, it was a terrible day for the marketplace. But it was, that vindication came, and it was bittersweet.
We talked about this before, actually, again earlier when we were chatting about the fact that when running portfolios, you only get those moments of pure vindication where everything feels great periodically. Most of the rest of the time, it's just living in terrible fear of trying to manage everything, make sure nothing goes wrong.
Yeah, I think, as you know, the people that are really, really good at this are, how do I put it? They're not tremendous social people.
No.
Right? They all have these crazy quirks and interesting lifestyles, and they're generally all good people. Like the ones that I've met, my good friends, are all so very interesting. As you know, many of them are here with us. They're our good friends.
Yeah.
But I live in constant fear. Again, I live with this constant feeling of inadequacy that drives me so hard to succeed and be a prudent fiduciary. And that's what's always driven me. Right? There are these two forces in life, I think. There's positive reinforcement and there's negative reinforcement, right? And both of those drive one to move forward.
And how do you manage the negative side? Because the positive side, that's easy. When it happens, you can manage it reasonably well.
Yeah, everyone can do that.
How do you manage the negative side of it? You know, when things aren't getting traction and it's not quite working.
That's this year. It's this year.
And so how do you manage that? Because
it's tough.
It hurts, you know, it hurts. It physically is not an easy thing to do.
Yeah, I think it's you internalize it to a certain extent. If you have a great team, you just talk it out with your team. And I think communication's key. It's like in life, right? Communication's key with anyone that you're close to. And in this case, we talk all of the time. And I have such a tremendous network of CIO friends of other asset management firms or other hedge funds or even academics that I share thoughts, concerns, feelings with, and bounce things off of. And that kind of friend network, it's both intellectual and emotional from a support perspective is how I deal with it.
Yeah, I think that makes sense because you need something because you can be on your own. As you said, the very quirky personalities, maybe they can deal with it. But if you're a more social creature, you know, it's a difficult thing to deal with because it's so public.
It's so public. Everyone has a scorecard.
That's right. And everyone wants to judge you on the last 3 months or whatever it may be. And
even if it's the last year, it's a tough judge.
Yeah. So how do your team's grown over time. How have you found that, managing people, and how do you manage people and give them some ability to take risk and also to feed you, because that's primarily their job is to feed you the ideas so you can implement them?
Yeah, so it's fun. It's a great question. And in the last year, I've actually engaged in a restructuring. And I've become more systematic in attracting, hiring, retaining talent. And I think talent is the name of the game. I've been a poor manager of people. I think I've been a better investor and a poor manager of people. And as I've grown my firm over the last 10 years, whenever I needed someone to cover metals and mining, finance, you choose where we need expertise. I would venture out and try to find the best person and bolt that person on. And I feel like I've bolted the firm together with some great people, but no real institutionalized process. So we've recently brought in, I think, one of the best in the business. It's helped turn around someone that advises half of the Fortune 50 CEOs personally. He's turned around just a couple of some of the world's best asset management firms, and he took me on as a project. So kind of for the last 6 to 8 months, we've engaged in kind of a beautiful cleansing of the firm. And I say that kind of in a good way, because it's been very positive for morale and also for strategic direction of the firm. One of my handicaps as a manager is I think I have a big heart, and I don't like, let's say, changing people's lives for the worst. I love changing people's lives for the better. And that means if I had someone in a position that was, say, a mechanic on a portfolio that was highly specialized, and that portfolio wound down, I don't fire that person, or I don't ask him to go find another job. I keep him along, and that means I end up keeping a stable of maybe B and C players, and I'm an A+. I need to be an A+ firm and not a B firm.
Maybe the way to deal with that is you enter into that employment in an honest way and say
I did.
That they have to decide if they're not doing what's right. If you're doing what's right for them, and if they realize they're not doing what's right for you, then they should be brave and make that. And that kind of helps you out from having to be the hard guy you're not.
In the end, what it turns out is these people, by not being the self-starting, entrepreneurial, engaged analyst that you or I would be if we were in their spot, they're doing themselves a disservice by staying.
Now, do you think you're difficult to work with? And I don't say difficult because you're not a difficult personality.
Yeah.
But you retain an awful lot of information about an awful lot of things.
Yeah.
So it's quite intimidating for somebody to come in with you. So let's say they're the metals and mining specialist, or they're whatever specialist.
Yeah.
Because you will then look at what their skill set is and apply it to 17 different other things that are going on and see the big connection. Is that hard for somebody?
What's hard for me? I think it is. I think if you ask some of the junior people, which it should be, Like
Sure.
you shouldn't be easy, right? You should be a great teacher and leader. And my deficiency again was when I'm hiring people and paying them what I'm paying them. I expect excellence. I expect knowledge. I expect them to think the way I think about things, and they don't. And that doesn't mean that I don't want discourse. That just means that when you're looking at a copper company and you're talking to me about how levered it is and where the copper is and where it's going, and I said, but wait a minute, what about global supply and demand? What about the last 30 years and this 10 years and where's it going next? And they said, well, I don't know. I said, well, what's your target price for copper? Well, I don't know. Well, you better get one soon because I don't want to hear the rest of this until you have those opinions. And you and I could disagree on that, which is great. Let's engage in that discourse. And if you convince me, I will change my mind. So I'm not that headstrong. I have an opinion. I've looked at these things, but I think getting my analytical team to think about things top down and bottom up is what I can be helpful.
If you push them to learn more about what they're doing, they get better for it. The firm gets better.
Yeah.
And I think that's the kind of thing that people like Julian Robertson would do. That's why he had so many good people working for him in the end, because he pushed them to say, well, that's not the full answer yet.
But I've heard he's tough.
Yeah, I'm sure he is.
I've heard he's really tough. But it's why his results are as good as they are. You're not there to win a popularity contest.
No, although I had a conversation similar to this with Mike Novogratz last week, a week before, and he said the same problem as you're having is, I'm too nice a guy.
Yeah.
And that's a hard thing because you have to learn to be a little bit harder and more ruthless. You can do it with your positions.
Yeah.
Like Alan Howard and people like that can manage people like they manage positions.
Yeah.
That's a different skill set.
True. I just think that comes with time. I don't think you're going to meet a 35-year-old person that really knows how to manage people like positions. I think it only comes as wisdom and not knowledge.
Yeah.
And I feel like Neo in the Matrix when you started seeing exactly how it worked. I felt like that recently in the last kind of year or so. I start understanding everyone's motivations, how they think, what makes them tick, and what I need to do to make the firm an A+ firm instead of an A- firm.
And so where did that epiphany come from? How did you suddenly start saying, okay, I now understand what I need to do?
It was actually internal. It was like looking at myself, right? It was realizing where my own deficiencies are and looking at the portfolio and seeing where those deficiencies are. And realizing when you do revisionist history, you look through where you've done poorly, how you could have done better, and then you realize, guys, we are really bad at this. We should stop this. Look, over the last 4 years, how about no more of that, right? And introspection, and more importantly, I think self-awareness. If you're self-aware, I think that makes you an incredible. It moves you so much forward in your ability to manage people and assets. And if you're not self-aware, you're doing yourself a real disservice. If you're pretending that nothing's wrong, it's a problem.
Yeah, and humility is a big thing that often misses in this industry.
Yeah. Although the great people have it.
Yes, I totally agree. They understand that, that you can't get this right all the time. It's a probability game.
Yeah.
And it's impossible. But if you always believe you're going to get it right all the time, it's a recipe.
You're never going to make it.
You're never going to make it.
Yeah.
So how do you stimulate yourself in terms of ideas, and how do you get fired up about stuff? Where do you get ideas from? How does it all happen for you?
It's so different. Japan came completely organically through a look in the world. Argentina came from reading a newspaper about Eliot's attempt to get involved in the Ghanaian courts and take the frigate from Argentina based upon their judgment in the lower courts, and that got me to looking into it. And then I just started realizing what their external debt position was in relation to GDP and their debt servicing costs, what they are, and it led me to believe that there's a real opportunity in Argentina. I know today everyone says that, but everyone wasn't saying that 2 years ago.
So let me guess. Virtually none of your bigger theme trades have ever come from standard research. It's come from you just seeing something, thinking that's interesting, asking yourself a few questions, and realizing it leads to more questions that are unanswerable.
Without a doubt. I would say 98% of our big themes were all thought internally.
Yeah, which is interesting because people think it comes from the street and street research, but it doesn't most of the time.
You know, the subprime idea came from a phone call. I had the epiphany on a phone call with a good friend of mine, Alan Fournier, who runs Pennant.
Yeah.
Alan and I were convinced, of course, that housing was doing what it was doing, and that was going to, it had a multi-standard deviation move from median home pricing did. And we were, if you remember, that was the golden age of LBOs, right? That was term loan Bs at LIBOR plus 250 for all you wanted to borrow. Companies were getting bought right and left. I was so fearful of being short equities, and we were thinking about the Rust Belt, particularly where the jobs had been exported from the traditional industrial base in the U.S. from the Rust Belt. So if in 2006 you actually already had property price declines and job losses in a very geographically specific area of the United States. So we were on the phone with a Royal Bank of Scotland analyst, and it was a securitization expert, because we were trying to isolate in a bond securitization which bonds were going to go bad and understand how that was going to work, because those Rust Belt bonds were likely to go bad because you had job losses and home price declines. And we were talking with this analyst, and he was explaining to me how a securitization works, Alan and I on the phone, and he explained to me that the bottom tranche, was the first 3% of losses, and the next tranche was another one, and then it was the exactly how subprime securitization worked. And I hung up and I said, Alan, this is it. He says, what do you mean? I said, did you hear what we just heard? The sub tranches are trading at par. This is crazy. And all he's focused on is the Rust Belt. What if this happens in the rest of the country? So that was the call that I can literally pinpoint back to the switch being flipped.
And that tells me something that I've always thought about global macro or investing in general.
But by the way, that wasn't the street telling me that it was a great idea to be short. He was just telling me how many of the bad loans were in there, and that we should look into how that works.
Exactly, and I think it's the key part that you need to be for all investing as an independent thinker. Because I think if you follow the crowd, you never get the right trades. Yes, you might be lucky because things trend for a period of time.
Right.
But you never get interesting trades or trades that really work, where you do your own homework and stuff like that. And that's what you've always done, is your own homework.
Yeah.
We've talked about how stressful it is and all the kind of thinking that has to go into this. How do you step out of that? What do you do to chill out and to keep the balance in your life?
Yeah. I've searched for that my whole life. I found it about 6 years ago. And my favorite thing in the world is to do free diving, spearfishing. So I know you live on an island. I could do that if I wasn't running this firm. Meaning, as a lifestyle choice, I'm a man of I have a little Hemingway in me.
And what is it about spearfishing and free diving that you like? I mean, I don't spearfish. Free diving I've had lessons in, and it's a fascinating thing because it's very internal.
It's internal. It's a beautiful thing. It's like when you think about the greatest battles in the world, they've always been civil wars, just like I think the greatest battles you and I fight are in our head. It's between ourselves, right? I think the biggest battles that most people fight are with themselves. And so when you get into, when I was in college, I helped pay for college I had a diving and an academic scholarship, and I was primarily springboard diver. And that was, I would say, 80% mental, 20% physical, even though it looks all physical. It's you versus yourself. It's you convincing yourself that you can do this and do it as well or better than anyone else. And free diving, very similar. It's you knowing yourself. It's you teaching yourself how to regulate your heart rate. It's how to control your emotions. It's made me better at controlling my emotions in the office.
That's kind of where I was going to get to this.
And the beautiful part of free diving for me and spearfishing is the day-to-day quote grind that we go through. My phone rings 24/7. I take that back. I turn my phone off at night. So there's only a select few that can get through at night. But during the day, I'm pulled in 1,000 different directions, regardless of how much I try to control my path through the day. Things pop up. You have people everywhere pulling you 50 different ways. The moment I go underwater in the ocean, it's zen-like for me. My phone can't ring. No one can bother me. I'm typically there with people that I want to be there with. My team. I always dive with the team. And then it's me versus myself. And it literally is Zen-like. And I've gotten so much better at being calm that I go 8 to 10 hours a day.
Wow. Because a lot of people do the similar thing with yoga, and actually yoga and freediving have a lot in common.
Do they?
Yeah. A lot of the great free divers now learn yoga to understand how to control their body.
Yeah.
And control their mind.
I have a problem with yoga. My mind drifts. When I'm free diving, I'm focused, right? I'm focused on the potential threats because I primarily do it all in the Bahamas.
Yep.
So, we see sharks every day. And I'm not that afraid of sharks. I respect them. So the difference for me between yoga and free diving is in yoga, we have, you're sitting there and you're in a solitary moment and you're trying to focus on things mentally, but I don't know. I need the free diving aspect of it to be really centered.
You have a physical centered. Yeah, you have a physical focus then as well.
Yeah, and I'm always searching for the next great hogfish or grouper or lobster to eat that night. We eat what we shoot, and it's a beautiful, beautiful cycle that I go through, and I can do it for weeks on end.
So when did you take up free diving, and how did it change you in terms of how you work?
It didn't initially. It was just something I'd always wanted to do, and I found a young man on an island in the Bahamas, and I asked around and said, "Who's the best spear fisherman on the island?" And everybody said, "It's Dave. It's Dave. It's Dave." And it's a 17-year-old kid who had been bitten by sharks on his hand. He'd been cut up on his foot by a propeller, and he's just a great kid. And over the years, he's become my boat captain, and he's now, I guess, 23 years old, and we've been partners now for 6 years. And every moment, every chance I get for vacation, that's where I go.
And as I said, you've actually noticed that whole process of learning that spill into your work and makes you calmer in how you think about things. And
yeah, it keeps me. You have to stay focused, and if you trade on emotion, you lose every time. And if you can divorce yourself of that, especially those real extreme, in extremis, those emotions you feel, you have to go the other way. Have to.
So let's bring us a bit more up to present date. Let's talk about markets a little bit. Now, I don't know when this interview is going to be out, so we don't need to talk about the here and now, but what's on your radar screen that you're looking at thinking, okay, I need to start looking into this a bit more? Because we know Japan and Argentina are two things you've talked about.
Right.
What else is out there you're looking at?
Is that a trick question? No. Those are our two primary focuses. We have a new focus, is something that we'll talk about in about 6 months from now, maybe a little less. That they're things that captivate me, and I haven't really run into something that's truly captivated me since I first ran into Japan, call it 3.5, 4 years ago, or run into subprime almost 10 years ago. And they don't happen very often, but when they do, it's such a beautiful intellectual exercise. I feel like it's international intellectual gymnastics, where I decide to go all in personally from a knowledge perspective and develop as much as I can, and get my firm up the curve as fast as it can be, and then we start positioning.
Now, I'm not asking you to have a crystal ball, but where do you think the balance of risks lies in the next year in terms of global markets, the kind of stuff that we all look at and talk about when we see each other?
Sure. I think we just saw something really interesting, right? The lack of liquidity is something that fascinates me. I saw moves in the swap markets as we sit here today. It's the middle of October. Last week was the week in which we saw the markets tumble, and we saw the plumbing. Forget the equities. I know it's hard to, but let's forget the equities. The plumbing in the credit markets, and most interestingly enough, the supposedly the most deep markets in the world, or the deepest markets in the world, U.S. rates. I saw moves that I thought we could never see in a day. So you have this confluence of events where the world has been driven by daily liquidity ETFs at the exact same time that we have broker dealers with their inability to take on risk because of Dodd-Frank. So market making per se, specialists on the New York Stock Exchange are all but extinct. There aren't true, real circuit breakers. So you see liquidity gaps, and the gaps are huge. So you go from a no-vol world to a vol world that goes off the charts literally in just a couple of days. And it's because I think of the manner in which the construct of the market is today. What worries me is how the construct works across both equities and credit.
Yeah, I think liquidity is a thing people don't really understand right now. And as you say, the vol of vol is so high that that's an interesting trade in itself.
Yeah.
It's a matter of structuring it.
Imagine if you were a levered high yield fund and you were hedging interest rate risk with swaps, and last week happens. High yield spreads blow out and government yields collapse, and you're levered. If you were 5 times levered, I don't know how much you lost. You lost 40% of your money last week.
Yeah.
Right?
And it makes me fear that there's a big unwind to come. I have somewhere deep inside me, I'm starting to fear that all of the carry trades of every way, shape or form are going to get taken out and shot.
Yeah, we talked with the dollar.
Just the dollar moving things, and just not even just emerging market carry trades, but anything that those yield trades, that everyone's borrowed money and invested in something else to get a higher yield. I just get the fear that they're going to get unwound.
You know, I hear you. So the yen carry trade's still going to work really well. Right?
Yeah.
But the dollar carry trade, not so well.
It's the dollar carry trade I worry about.
Because of the policy divergence. Yeah. And you mentioned early on that macro really hasn't been a great place to be for the last, God knows, 5, 6, 7 years, because central bank intervention has kept kind of the vol low, and the traditional macro analysis just doesn't work when the central banks have the training wheels on the market. The interesting thing is, as we sit today, we're all but about a week away from the Fed taking the training wheels off the U.S. market. And I think that's the fundamental basis for the dollar carry trade kind of going poorly going forward.
And I also think that it's about time we tested exactly what the central banks can and can't do, because people make assumptions, and I think people make too much assumptions about the power of central banks' abilities, as opposed to potentially realizing that it was just market reaction that created that.
Yeah.
That really maybe monetary policy doesn't do all of the things that we expect it to do. We could probably talk all day about macro stuff, but I think it's going to be an interesting 2015. I think things may be changing, and it's just for us lot to all just focus and just see, has something changed? If it has, there's opportunity.
I predict that the CalPERS announcement of a credit guy saying that they don't need hedge funds, that they can just be long stocks and bonds, which looking back over the last 5 or 6 years has been right. When you have all the central banks keeping the car on the road for you, you don't even need to drive. And that's going to prove to be a market topping event. And I think 2015 will be the year of macro versus traditional kind of long short equity, or even just long equity. And I think it's going to be really exciting. People don't know how to think through policy divergence. And by the way, nor do I. I have an opinion, but no one knows what's really likely to happen. But I think a few things are almost certain. Vol is going to be higher, not lower. Macro is actually going to work because the training wheels are coming off. And policy divergence, I think, is where all the money is going to be made.
Perfect. So, this is, as you know, part of the chain reaction series. So, your job now is to find somebody you want to interview to get some interesting insights out of. So, who are you going to interview next?
Sure. So, we're going to talk with John Burbank from Passport Capital. John is when I sit and have dinner with John's a good friend of mine. When I sit and have dinner or spend a weekend with him, you know, I feed off of his brain. He's a brilliant man. He's a very thoughtful man. He's everything he's everything you want to be. He's a charitable, thoughtful, brilliant, great friend. And I think we're going to learn a lot about how he manages money.
That'd be fascinating. Carl, thanks a lot, as ever. Great to see you.
Thank you, Raul.